When we think of insurance, we usually just picture a really straightforward transaction, right? You pay a premium, and in return, you get the peace of mind that your home, your health, or your car is protected. But behind those everyday policies lies a massive, incredibly intricate financial engine. Today, we're diving into this explainer to look at the sustainability accounting standards for the insurance industry. We're specifically zeroing in on systemic risk management, and we're going to break down how the non-insurance activities of these massive entities can send ripples, or honestly even shockwaves, through the entire global economy.
It's a fascinating paradox when you really think about it. Here we have an industry built entirely on mitigating, pooling, and sharing risk. They're supposed to be the ultimate safety net for a well-functioning economy. But what happens when that safety net actually becomes a potential threat to the stability of the global financial system? How do entities designed to protect us from unexpected economic shocks end up potentially causing them? It's a vital question, and it's exactly why financial regulators and standards boards like SASB pay such incredibly close attention to what these companies are doing with the capital they hold.
Section 1. The two sides of insurance. What you see versus what's underwater. To really grasp this systemic risk, it helps to think of the industry as a giant iceberg. Now, on the left side, your traditional lines like standard property, life and casualty insurance, that's the visible tip of the iceberg. It's the traditional pooling and sharing of risk. It's predictable, highly regulated, and generally very stable. But contrast that with the non-traditional products on the right: complex annuities, alternative risk transfers, and financial guarantees. This is the massive, hidden underwater portion of the iceberg, where insurers engage in capital market activities that go way, way beyond just paying out claims for a fender bender.
Section 2. Amplifying systemic market risk. When the iceberg tips.
So, what exactly is lurking down there in the dark? According to the standards, these systemic non-insurance activities are investment and funding operations that result in maturity or liquidity transformation, leverage, or the imperfect transfer of credit risk. Think about instruments like repurchase agreements, or a big one, writing credit default swaps, or CDS protection. When insurers engage in activities like writing derivative contracts that don't actually hedge a specific risk, they undergo a massive transformation. They stop being simple risk mitigators and morph into highly interconnected financial giants, taking on the exact kind of market vulnerabilities we usually associate with Wall Street investment banks.
And if an insurer leans too heavily into these complex capital market activities, they can trigger a very heavy regulatory label, a systemically important financial institution, or SIFI. This designation basically means regulators have looked at the entity's size, its deep interconnectedness with other markets, and its sheer complexity and concluded something terrifying. If this single entity fails, it can transmit a massive threat to the broader financial system. They are quite literally deemed too big to fail without dragging the rest of the market down with them. Now, wearing that sci-fi crown comes at a steep price. Central banking systems subject these institutions to intensely strict prudential regulatory standards. We're talking tough limits on risk-based capital, strict caps on leverage, significantly tighter liquidity requirements, and rigid credit exposure limits. But perhaps the most sobering thing on this list is the mandatory plan for rapid and orderly dissolution in the event of financial distress. It's basically a living will for a corporation. Regulatory compliance here is incredibly costly, and failing to meet these strict oversight thresholds, that could lead to absolutely devastating penalties.
Section 3. Measuring derivative exposure. Auditing the domino effect.
If this interconnectedness acts like a giant line of dominoes stretching across the global economy, we desperately need a way to measure the gaps between those dominoes. Under SASB metric FNN 550A.1, insurers have to categorize their derivative exposure into three distinct buckets. First, total exposure to non-centrally cleared derivatives. Second, the total fair value of acceptable collateral posted with a central clearinghouse. And third, total exposure to centrally cleared derivatives. This level of transparency is absolutely essential for investors to audit exactly how much leverage an insurer has floating out there in the open market before a crisis actually hits. The contrast between these buckets is stark, and it really highlights where the danger lies. Centrally cleared derivatives have a middleman guaranteeing the trade, adding a much-needed layer of safety. But non-centrally cleared or over-the-counter exposure, that is the Wild West. The standard requires insurers to report this exposure to all counterparties, completely regardless of their credit quality. This means the insurers is directly exposed to the potential failure of whoever is on the other side of that bespoke trade. If their counterparty defaults during a market panic, the insurer takes the hit directly.
Section 4. Risks in securities lending. What's at stake?
Beyond just derivatives, securities lending and the reinvestment of collateral assets form another huge chunk of that hidden iceberg. Under SASB metric FN-IN 550A.2, insurers have to disclose the total fair value of these reinvested assets. And we aren't just talking about abstract numbers on a spreadsheet here. We're talking about tangible, everyday assets tied up in these complex webs: real estate, actual mortgage loans, bonds, equities, and cash. When these foundational assets are used as collateral in lending schemes, it brings the systemic risk directly home to the wider real-world economy. And here is where the trap actually snaps shut. Liquidity risk is the silent killer in any financial crisis. It generally arises from mark-to-market changes in the value of underlying instruments. So if a sudden market shock happens, it can trigger an absolute avalanche of collateral calls on those derivative contracts. If the insurer has invested their collateral in illiquid assets, they might not be able to sell them fast enough to meet the call. The value of the collateral plummets, the demand for cash spikes, and the insurer's liquidity is just squeezed dry in a heartbeat.
Section 5. Managing Capital and Liquidity. Navigating the Storm.
So, with all these dominoes perfectly lined up, SASB's metric FNN 55A.3 demands that entities rigorously manage these vulnerabilities. To survive a financial hurricane, institutions can't just treat this as some compliance checklist. They must adopt comprehensive enterprise risk management policies as their core operational doctrine. They've got to aggressively stress test their portfolios against worst-case scenarios. They need bulletproof contingency plans for when the market inevitably drops. And above all, they must cultivate extreme agility, ensuring their framework responds instantly to sudden external market shocks.
So, as we wrap up this explainer, we are left looking at a massive, intricate machine operating quietly beneath the surface of our everyday insurance policies. We've seen how non-insurance activities, like writing credit default swaps or engaging in complex securities lending, fundamentally alter an entity's risk profile. It can turn a stabilizing market force into a systemic threat that requires intense CFI oversight. But financial markets never sleep, and they're constantly churning out new complex instruments, which leaves us with one critical thought. Are the financial watchdogs and our current reporting standards truly adapting fast enough to keep pace with the hidden complexities lurking just beneath the surface? For the sake of the global economy, it's a question we absolutely cannot afford to get wrong.